Good afternoon, everybody. Nice for you to join us. I'm sorry we've had so many technical issues this week with this one. I'm sure Mark, who's assisting me with this, will explain a few things in a moment. Hopefully we've had a few people joining and we can start any moment now. Leave it over to you, Mark.
Yes, thank you, Peter. And yeah, good afternoon and welcome everybody to the latest instalment of our PFP webinar program. So yeah, my name is Mark Williams. I'm one of the business development managers here at PFP. Just like to sort of echo what Peter stated in relation to some of the technical difficulties. I can assure you it was outside of our control. It's a Teams issue, I believe. It's been a number of sort of webinar issues across the board under Teams over the last couple of days, whereas your registration link wasn't followed by the actual link to the webinar itself. So it was a manual process that we had to carry out this morning. So those of you that are on here, great. Obviously, you've received that link and you're on and joining us. So that's the main thing. And a recording and the slides from today's webinar will be sent out in due course after the webinar. So you've got access to all those, and any joining late will have the full recording as well. Then. So yes, today's webinar joined by Peter Fry, our resident tax specialist at PFP. Tax consultant, and Peter's going to be going over some of the property changes and especially the furnished holiday let changes in terms of the regulation that we're seeing. Some key points to go into regarding remaining compliant regarding these changes and how you and your clients can benefit from Peter's insight, hopefully. So yeah, Pete's going to share his slides. As always, there's a Q&A box on the Teams call for you to pose any questions to Peter throughout. I'll be keeping a look at the Q&A session so I can pose those questions to Peter as we go through today's webinar then. So I believe there's still a few people joining, Peter, but without further ado, that's over to you.
Okay, thanks very much, Mark. As Mark said, I'm Peter. I am the senior tax consultant here, and I have all the fun and games with doing this. First of all, disclaimer, but I'll let you to read that when you get the things. What we're going to discuss, we're going to look at a quick overview of what there was before, some of the good things that were there, some of the really nice bits about furnished holiday lettings which aren't going to be there anymore. So what's changing? We'll look at the various things there, but what we know, the draft legislation, it's now in the Finance Act, I know, but in the draft legislation there were some thoughts on how it should be worked which are slightly different, and we need to know that part as well. But there's things that aren't changing. Let's have a look at those, and we're going to look at some areas of uncertainty, because they're, you know, as ever with any act that is written by the Treasury, there's always some uncertainty. That's never straightforward. And some ideas of when you're actually talking to your clients. I understand my slides have disappeared. Let me just...
That's great, Peter.
Okay, let me just zap through where I was. Right, first of all, let's have a look at the old rules. These related to furnished holiday, furnished accommodation in the UK and EEA areas. They had to be let on a commercial basis. So, yeah, if you had your property that you let out to your family and friends and for just enough to cover things, that didn't count, and that was just looked at separately. But you had to look at a 12-month counting dates. It had to be available to the public for 210 days or more. To let for half of that or more, excluding long-term lets, and a long-term let was anything over 31 days that didn't exceed 155. It was a pretentious, you had to separate out business UK and UK, so you had the ordinary properties and the holiday lets, overseas properties, and EEA furnished holiday lets. You had to separate each of these, so you had to look at them totally differently because the rules were totally different for each of them. Losses, yeah, so the Furnished Holiday lets were separate businesses, and the losses were carried forward but couldn't be offset between them. So you had to separate out your European ones and your UK ones, and you couldn't then use them any other way. The ordinary, for want of a better word, of letting properties, the losses could be set off against Furnished Holiday lets on a UK to UK basis or an European to European basis, but you couldn't do it the other way. You couldn't set off holiday lets against those, which was always seemed very weird to me, but there you go. With income tax, there was no restriction on the loan relief, which there is on ordinary lettings. You could get capital allowances, and the profits counted towards pension contributions, which was very useful. A number of people I know have not had other income really, and they've used this for their pension contributions. I don't know what we're going to do with them later, but we'll have a look at it. There's a greater flexibility in doing this for splitting the income. If it's a holiday let, you could easily split it between each of the spouses or civil partners, and it made it very useful and helped a great deal, particularly when the property is owned 50-50. You didn't have to do all the other forms and everything to try and get it to fit with how you wanted it to work. On capital gains, because it was a deemed trade, you got bad relief, business asset disposal relief, which was always a useful thing. Admittedly, now bad relief isn't as useful as it used to be, but it's still better than having to pay the gain fully. You get a gift relief or holder relief, so if you're passing it through family, that could work. You could look that way. If you're selling it, you could roll it over into one of the list of rollover type assets. I'm still trying to find the person who's going to roll it over into a satellite, which apparently you still can do, but I've never seen anybody do it. And relief on loans to traders very rarely happened, but it was there. And if it was in the company, you could do the substantial shareholding exemption because it was a deemed trade, so that all worked through. The changes, right? First came in Spring Budget 2024, and they abolished the Furnished Holiday regime totally. Draft legislation was published in July, and now it's Schedule 5 of the Finance Act 2025. What it says in essence is the special treatment doesn't exist from now. So all the things that we've known over the years and years has just disappeared. And we now have to go back and consider all of these as normal, just straightforward property lettings from now on. And you have to just go through that and look at the rules on there, which is a real pain and has caused a lot of people a lot of pain. However, there's no formal cessation of the furnished holiday letting business, which some people are saying, well, it's not. And we'll have a look at this in more detail in a bit, and a different suggestion on how we work some of these things through. But I've always felt like I don't see why there should be a cessation here personally. For instance, if you were, say, a partner in, I don't know, a dentist, and the other partner retired, you're still carrying on as a dentist, and you don't cease that trade. You could just continue it as a sole trader. So effectively, you're not. It's the same sort of principle. You're still continuing doing the same business. So I just find it hard to understand why we would actually have a cessation here. The losses carried forward with now have to look at the geographical distinction in more detail, because that obviously, as we looked earlier, it's going to be much more in point. Capital allowances, dear, right. As we said, there's no cessation, so we don't have any balancing charges or balancing allowances. So it just continues with the small pause there. You can't add to your pools after April 25. They are there and that is fixed and it can't change at all. They're carry forward and you can claim written down allowance against those pools all the way through. Doesn't really necessarily help you because there's very small figures and they're just going to continue going through. One thing we could consider is a small pools election, which is under the Capital Allowances Act 2001, section 56A. It basically says if that pool has a written down value of under £1,000, you can write it off in one go. I think a number of these things, that a lot of them have just gone through anyway because they've been charging AIA, but there's still going to be some floating around from previously that you may like to just write off in one go. And it's worth considering and seeing if you can do that, because it's going to be a faff trying to remember what it is for years and years and years. It's now going to be the domestic items relief. So what you buy, we look at the letting rules. So as you buy them, you get the relief. If they are replacements, you don't at the beginning. So you have to look at all the thing and track through all those items. Capital gains relief, as we've gone through, has been withdrawn. So rollover relief will not be there. Gift relief, bad relief, unless the business ceased prior to 6th of April 25. We'll have a look at that in a moment, because this is where we're getting to an interesting conversation about has this ceased or not, but we'll have a look at that in a moment. And the relief for loans to traders and the substantial shareholding goes. But I don't think they're very heavily done. This is where we start getting into the anti-forestalling rules, which is mostly down to the capital gains position. And if you're selling a property that was previously a furnished holiday let, which is where we're having a number of questions from people at the moment on our helpline, that there is some confusion as to when and what can actually be treated as under the business asset disposal relief and what is just treated as an investment from now on. So the anti-forestalling rules comes in, but which basically says if you made a contract between those dates where the asset is transferred after April, so if you made a put the property on the market soon after the 6th of April, and it took 6 months to get it through, and then it took longer to actually get the paperwork and everything else to do, which often happens. We know with a lot of these, with property sales, could take the year. If it's taken over a year, well, then you have an issue. In respect of which you would want to claim one of these, which would likely to be something like the business asset disposal relief, I think is the main one we'll have. The others don't really, but they have to have that sort of claim to be caught in the anti-forestalling. The claims are only valid if the disposal was not intended to withdraw from these reliefs, and the contract was on wholly commercial reasons, or the parties to the contract are not connected, which seems a bit weird because you could do it for these reasons, but they're not connected. So yeah, it just seems a bit strange. And another and in there, you make a statement to the effect as part of the claim. That statement, it doesn't outline what they think you'll have to do. The issue, as far as I can see, is you'll have to put something in the white space of the return to say that you've considered both all of this, and it wasn't done for that, and it was done for that. There's nothing outlining what they want, which I think is really quite sad, and I think they should need to do this. And I know the COT is actually asking for clarification on what they're actually after here, because let's be honest, the number of times you've made a statement to the revenue and the revenue has just basically said, don't agree with it, and you have to prove yourself innocent with the revenue, as opposed to the other way around, and then proving that you're doing it because of these reasons. What information you'd have to collect is difficult to tell. They should go on you saying you didn't do it for commercial reasons, and you did, it was done wholly for commercial reasons. It wasn't done for anything else. But if you've got somewhere out there where you have a property that has been making money all this time, will the revenue then say, well, you can't be doing it for commercial reasons, because why would you want to get rid of something that has been making money? There's lots of thoughts about this, and as I say, we're waiting for the revenue's ideas on what they want in that statement, to make sure that everybody knows what it is. Once we find out what that is, I will be sending out a circular to everybody just to update them on what they actually want. What we can still do, or what is still there, the VAT treatment. If you were having to charge VAT, you still have to. It doesn't change because it's no longer a business. But you still have to look at it for your it's only changed for income tax and corporation tax. It hasn't changed for VAT. So you're still looking to see if the two together, with if you've got another business, and if it's in a business, whether that is actually going to go over limits and things. Business rates. We're saying now it's no longer a business, but apparently business rates still qualify, which seems a bit weird. And business relief for inheritance tax is still there. No sense really with why. But anyway, some of the uncertainty. How will the new short-term lets be treated? Now, it does seem very strange. I was saying a bit that the reason for the furnished holiday letting rules came in many years ago was to make some certainty on where you were trading and where you weren't. And we have to consider whether you are actually trading here. It is very difficult to know, because a lot of the time, by doing in and out all the time, there could be some argument on trading, and we'll have a look at some of the thought that I've got on that in a short while. The other one is, if you've actually started a one in 24/5, what's the relevant period? Well, you're going to have to look at the 12-month rule, as we were talking about earlier, to see if you've actually done the 105 days and the 210 days, even when it goes over past April. So you're going to have to look at a 12-month period to see what period that you actually do qualify between the whole lot. It is a bit of a problem because they don't qualify in the future. So why would you look at that, and why can't we pro rata it? But that is the way it seems to be working. As we've said, the main impacts really capital allowances, loan interest, and relevant earnings. And I think they really are going to be a serious issue in the future. Relevant earnings, we have already seen people with issues that are considering what they can do because they wanted to put more money into pension pots, and it's just not been there. But that does impact on these new lets. Again, as I said, you've got to go for the 12 months, even if it goes beyond the period. When the holiday lets were brought in, as I said, there was lots of cases, and it was the key driver behind the introduction on whether it was actually a trade. this abolition basically is going to bring in a lot more uncertainty on what is a trade. We need some guidance, we need some case laws done, but it's going to be quite difficult for us to get those. Obviously, it'll take a long time for that guidance and case law to come through that we have previously had. It's a little worrying about with thinking of what the revenues interpretation would be. We all have seen cases over the not too distant past of the revenue actually taking strict hard lines on these things when rules have changed. And I wouldn't be surprised if we are going to have a little bit increase in inquiry work into these sort of cases, with people looking at with the revenue looking at, you know, what you were doing and why you're now putting it as a trade if anybody goes down that route. What we need to consider is the usual sort of things that go round on cases and old case law on what is a trade and what isn't within lettings, which I will explain shortly. The availability of bad relief, the revenue's view is because it's not a cessation, you can't get it, basically. And they say the actual cessation of business activity is required to obtain capital gain relief. So you would need to cease the letting before the 25th of April 25 with a hope of getting bad relief. That's their thought, and that is, I'm sorry to say, I go along with it. It's not a cessation of a business unless you can actually show that you have properly ceased, there's no more letting, and then you potentially can get BADR if the disposal was within 3 years under the normal rules. I think it makes sense to me that this is the case because you are not actually ceasing as such. You're changing the way it is being taxed. You're not actually changing the activity that you're continuing. There could be some arguments that you're now, if you can't have a furnished holiday let and you now decide to let it as a long-term one, well, that's a different situation. We'll have a think. But in this context, if you're continuing doing the same thing, where's the cessation? It's just the tax rules have changed. It's not the cessation of the actual activity, which is what the revenue is saying. I have some sympathy with that. However, there are alternative interpretations. If the landlord changes to long-term lets, as I suggested, does that not cease the business? So it's ceasing what was actually there. It's not the same trade. So if you could argue that the last letting was actually longer at the end of last year, and they are going into long-term lets, well, that would be a cessation of the trade. Whether that has to be during 24/5 or whether it can be argued that it is for the future because it is actually changing everything, it's difficult. I think you would only really do it when it's back then and not for the future. Not a lot we can do about it now, but some of our clients may well have actually decided, well, we're not going to get all the rules and the reliefs that we were getting. So let's change it so that we've got this position. But what date do we use? Well, probably the 5th of April. But I think it would potentially be earlier because if you are changing to a long-term lets during the year, you do it from that date. If you are trying to justify that you have actually ceased trade, you may have an argument with the revenue. but then you would actually be looking at the 5th of April or 31st of March if it's a company to say that it has now gone on to a commercial letting as opposed to any other principle. I don't think it does. Does it allow for anything after that? The finance bill basically omits actually allowing any capital gains relief, which is actually quite interesting. They haven't actually written it properly in the bill, and therefore in the Act, it's not there. Which seems very strange that they haven't sort of done a separate one for capital gains. But let's be honest, they're not going to be deemed as a trade, so you can't get business asset taper relief for the future. But if you actually read all the legislation through, when the business asset disposal relief came in, it wasn't actually in the rules, and therefore it messed up the whole of the interpretation. It wasn't there, so it was actually just the revenue allowing us to do it for holiday lets. So, you know, it's going to be interesting from that. What we can do now, we're going to need to do a Form 17. If you've got a property that's 50-50, and historically you've always had it as, for instance, the wife who has done all the work on the actual holiday let, as we know, for normal lettings, everything follows the normal rules. So it all hits the underlying capital of the property, so it will only be 50-50. So you would have to actually put a Form 17 in now. The whole problem with where we've gone, that flexibility where we could actually move it back and forth if we needed to, is totally gone. So it just gets 50-50 or nothing or whatever. We have to do something now to actually get it to what we want. Once you've got a Form 17 in, you can't change it. It is what it is. If you're saying it's 90-10 or whatever, it is 90-10. You have that flexibility that we've had before, as you would with, like, say, a partnership, to actually play around with the numbers between the partners. So it would actually go through. You need to do this form. If you want to change it, think of those and get them all done as soon as you possibly can, because remember, they are not able to be backdated. You can't go back or forth. It is just, that is what it is. If in the future you have an issue where, for instance, one spouse uses a deed of trust to allow the other one to have the capital for the future, you could do something else then, but you would have to go into legal documents to get it done so that one has actually transferred some of the ownership to the other to change the numbers. But at the moment, that is how it will be, 50-50, unless a Form 17 has actually been sent in. Other thoughts? Pension contributions. You're going to need to check the impact on the relevant earnings. Particularly, we'll have a number of people who have actually been using those in the past, and they need to discuss with their pension provider to ensure that they're not over contributing, because we do get quite a few inquiries through recently at the end of each year from the revenue pointing out that these have been over contributing it, but you haven't actually put it on your return. Could you actually go consider it? You've got more tax to pay on these figures. We've seen a number of these cases where particularly you have somebody in a business as an employee with their employer contributions going in and then putting in a little bit and not realizing, and the pension provider having it almost like a standing order and taking money every year. And we've seen massive inquiries based on over contributions of, I think the worst one I've seen is £1.20 but they do get uppity, and we end up having lots of back and forth to try and sort this out. A couple of ideas. Is there a possibility of turning your Furnished Holiday let into a bed and breakfast? My thought was considering, if you think you've got, say, a farmer, because farmers are being hit quite heavily, because if you think about your usual farmer, a lot of them have diversified and actually have holiday lets on their farm. I stayed on quite a number of them over the years. If they have, say, 3 or 4 things next to the farmhouse, converted stabling and whatever, is there a possibility of them turning it into a bed and breakfast? Bed and breakfast doesn't have to be only people staying per day. People can stay for a week at a bed and breakfast. That's not an issue. But what if they hung on the door handle every morning a bag with a few croissants, a few pain chocolat, pot of jam, some milk? Are they providing enough of a breakfast and a service to actually push it into the bed and breakfast walls? I'll leave that with you to think about. See if there's anything you could consider with some of your clients to think, is there a possibility of turning this actually into a trade, back into a trade from there? Because clearly what we want to do is turn these into trades so we can go back onto the old rules. That's what it's worth having a think and look at the rules again, which are in the revenues manuals, on what a B&B is, and then look to see if you can actually slightly change your model to fit within the bed and breakfast rules. Just a thought. On the issue of turning it into a trade, we have to look back at various cases, and one I always like to hit is the Ramsey case, which was an upper tier tribunal case some time ago now. It's amazing how time flies. It's an old case now, really. Mrs. Ramsey had a block of flats, and she looked after them and looked after all the communal stuff, and she did lots of bits and pieces. She painted here and there. She got her own tenants in. She did forwarded the post when they'd moved, and she was spending up to 20 hours per week doing this. Well, if you are doing holiday lets and you go back to the farmer with, say, 3 things, and you do a lot of letting through your own website, for instance, updating all that and collecting the money and doing things, and then doing the clear in and clear out of the people, you're getting up quite well towards this 20 hours a week. Could you therefore use that case and that sort of thoughts to push this over into a trade? So there's 2 sort of ways potentially we could look at what you're doing just to make them more commercially a trade. And if you can do that and you can put details together and make a plan, because as soon as you do this, the revenue will be asking, why have you done this? Surely you're just trying to do it to get out of the rules. Well, yes, you are, but this is what is happening. And if you can actually put something together to show them what is happening and how they are complying within the sort of guidelines set out in Ramsey, or doing the guidelines on bed and breakfast, then potentially you are then turning it back into a trade, and you go back to all the good things that we had before, and manage to keep going without worrying too heavily on where we were. I think we got to a point where we need some questions, Mark, because I am running out of.
Yes, the Q&A box has been very quiet, Peter, and okay. I'm hoping that's testament to how well you covered everything off, and not another technical difficulty through Teams.
I don't think so. Yeah. Carry on.
So it's been rather quiet. I think the questions that have been posed, I do believe that you've covered these off, but I will pose them to you. If it is not deemed a trade, then why is there no cessation of trade?
Yeah, it's very difficult. As we've looked at there could be a cessation of a trade if we have to if we go down some thoughts on this, and there's a lot of people out there considering it is. But as I said, at the moment I don't see that is going to work, because you aren't actually ceasing doing what you were doing. You're doing the same thing. It's just the tax rules that have changed. It's nothing actually physically that you've done. So you can't really do anything. It's unusual for me, as people who know me will know, that agreeing with the revenue's interpretation on something is very against my nature. But I think in this case I agree with them.
And the only other question that was posed, you did mention that when we do get clarification from the revenue, that we will be circling something out to everybody. But yeah, the question was, how do we make a statement to validate a claim? But you've already
very
covered
difficult. I think as far as it is at the moment, you can only be able to make it on the white space. But you're going to have to provide as much detail as you can to try and prove that you haven't actually gone against any of the rules that normally would be there, and the ones thereafter. How you prove that your intention wasn't to do this just to get out of the new rules is very hard. I can see the revenue challenging most of those that are made, but again, if you do put something in the white space, if they don't challenge in the year, they're out of date, and I can't see that we'll then be allowing them to have any possibility of trying to claim that it's a discovery after the period that is out of date. So it's well worth making sure you put as much detail as you can in there, without going over the top, obviously, but just get the bits and pieces you can to back up why you've done it. The one I mentioned earlier, that I can see the revenue arguing, well, why were you getting rid of this if you're making so much money? Well, just couldn't be bothered to do it anymore. We have changed our lifestyle, things like that we need to put together to actually make a proper argument with these things. It's going to be very difficult, and I can just see the arguments going through with the revenue once we get to these things later. Oh dear. Yeah,
thank you, Peter. They were the only questions that were posed. So thank you for your response.
It's been a short one today, but I'm sorry, but it's technicals and things. It's always been a difficult one. That's probably for you, Mark.
Yes. So our next webinars, then, as you can see, we have a VAT update on the 13th of May with Liz Mayer. So more information will be coming out regards to that in the next couple of weeks, and then we have a June webinar date to be confirmed with Rand, our R&D partners, to discuss the R&D issues that we continue to face and see from the revenue. So they're the next two webinars in the programme, and communications to look out for going forward.
We look forward to seeing you next time.
Yes,
hopefully we won't have any of these issues next time.
Yeah, thank you all for attending, and have a great rest of the afternoon. Thank you.